When is the perfect time to lock your interest rate? Well, that is a great question. So we're going to discuss today in this video of when is a good time to lock your interest rate. So first, let's start with this. What is an interest rate lock? Well, it is just like it sounds. You're basically saying at this particular time and this day, I want to lock my interest rate, which is essentially an insurance policy that says that the rates aren't going to go any higher than what you've locked them in at. Now, rate locks work in increments. 15 days, 30 days, 45 days, 60 days, 75 days, 90 days. I think you get the picture. And the longer that rate lock lasts, then the more expensive that rate lock's going to cost. And so when you lock an interest rate, not only are you locking that rate, but you're also locking it for that particular duration of time. So for instance, if you have a sales contract and you're going to close in 30 days, you could do a 30-day rate lock. If you're going to close in 75 days, you would want to do a 75-day interest rate lock. Now, once again, the 75-day interest rate lock is going to be slightly more expensive than the 30-day. If you were to close in 40 days, a 45-day lock would be enough for you to be covered during that 40-day period. So it's not just locking the rate, but it's also the duration of the time. Now, why this is important? The interest rate is obviously attached to your payment. So when you're looking at your payment and you see it on a specific interest rate, you know that when rates go up, your payment's going to go up as well. Now, interest rates will move on a daily basis, sometimes even during the day. Now, if we're in a market where the rates are moving up, if this goes unchecked for several days, your lender doesn't contact you and you're floating, this means that your payment's going to be going up along with it. Now, this could cost you hundreds, if not thousands of dollars over the term of your loan. So it's important to understand when you're going to lock, why you're going to lock, and the duration of the lock. So when should you lock your interest rate? Well, the most important thing is you want to be under contract, because if you're not under contract, you can't. Interest rate locks are attached to the property. They're not attached to your application. They're attached to the property itself. So if you find a property, you go under contract, you lock the interest rate. Something happens in the inspection and you say, you know what, I'm not buying this house anymore. You stop that application, you also stop that rate lock, and then you would start again when you find a new property. You also, as I mentioned before, you want to make sure it's within the closing window. So if you're closing in 50 days, you do not want to do a 45-day lock. You probably want to do a 60-day lock. Or if you were closed on 41 days, you'd want to close on a 45-day lock versus a 30-day lock or a 60-day lock. So you want to make sure you time that up. Also, you want to make sure that you're extremely comfortable with the payment, because once again, if you're comfortable with the payment, the interest rate then should probably be locked, because if you don't lock it, you are gambling and your interest rate could go up as well as it does with the interest rates. And right now we are in a volatile interest rate market. So rates can go up, they can go down in pretty quick manner. So when you're looking at this in totality, if you're thinking, well, I have some time, maybe I'll gamble. Guys, it's not about necessarily timing the market. When it's volatile, one economic report, one international crisis could happen. You could end up, someone's dropping bombs or missiles on another country. It starts to change the dynamic of the economic reports, and all of a sudden you could find your interest rate going up. And on the flip side, you could find it going down. So you want to make sure that you're timing your interest rate lock according to what the market is doing. But once again, when you're comfortable with the payment, that might be a great time to lock. Now, when would you maybe want to wait? Well, there are times in the market where it's trending downwards. And so when it is trending downwards, it's probably a good idea to just let it keep going. And maybe then at that point, try to find something where you think that you're maybe at the bottom, but more importantly, did you save yourself 1/8%? Hey, that's a win. That might be a good time for you to go ahead and lock your interest rate. The other part of it that sometimes it can make sense is if you are, for instance, maybe you're in new construction and you see that the rates are going up and down, but you're really not going to close for maybe another 150 to 180 days out. and you really don't have any fear that the rates are going to get really away from you or go up substantially, it might be worth the gamble to wait a while before you lock your interest rate. Once again, the longer the duration, the more expensive that the interest rate's going to be. So using this as a guide will kind of give you some understanding of like when should you lock and when shouldn't you lock. But the common mistakes that I typically see what people will make is one, like I mentioned before, they're going to try time the market. Guys, this is very difficult to do. I've been doing this for 20 some years. I can give some recommendations to what I think the interest rate's going to do based on the market reports that are coming up, but sometimes they surprise you and the interest rates go the opposite way of what you expected. Also, I mentioned if you've got a long waiting period, sometimes you wait too long. You keep thinking that time is on your side. When it hits a specific rate, you should have some strategy behind that and lock when it hits that specific point versus waiting. Once you get too close to your closing, you're basically going to be under the pressure that you have to lock your interest rate, and you maybe have wasted a better rate within the last week or two thinking that you had time on your side. Thirdly is you don't really have an understanding of what causes rates to move. And this is where it becomes important to utilize a lender that has an understanding of what causes interest rates to go up or down. And this is probably the biggest common mistake that I see, is relying on a lender that really doesn't understand the market themselves. So it isn't about timing, it isn't about guesswork, and it's not about luck. Luck could play a part in it, but mostly it requires strategy. You and your lender should work in tandem, and the lender should be able to explain to you what's coming up, why interest rates move, and also give you your options. Here's an interest rate, these are the costs associated with that rate. Here's another rate, here's the costs associated with that rate. Here's another rate and the costs associated with that rate. See, rates just aren't static. They come with a cost. The higher the rate, the lower the cost. The lower the rate, the higher the costs. So ask some questions of your lender. If they're having a difficult time answering questions about interest rates and what makes them move, you might be working with the wrong lender. So once again, it requires strategy. If you're interested in learning more about interest rate strategy, like and follow my page or reply to this video, and I'd be more than happy to answer some questions for you.